Welcome back, everyone. Today, we're breaking down one of the most influential books on investing ever written, A Random Walk Down Wall Street by Burton G. Malkiel. Now, I know that investing can seem confusing or overwhelming with all the stock charts, financial jargon, and market fluctuations, but we're here to make it super simple. Whether you're brand new to the stock market or looking to improve your investment strategy, this video will give you clear guidance and principles that can lead you to financial success. So, what does Malkiel mean by a random walk? According to him, trying to predict the stock market is like taking a random walk. It's unpredictable and full of surprises. In fact, Malkiel's perspective is that short-term market movements are nearly impossible to predict with any consistency. This may sound disappointing if you're hoping to learn how to pick the next big stock. But here's the good news. Malkiel's approach focuses on practical strategies that don't rely on guessing the next market move. By the end of this video, you'll understand why the random walk idea is actually great news for everyday investors. We'll cover the fundamentals of building a solid investment strategy, including why it's beneficial to invest in the entire market rather than betting on individual stocks, and how to build a diversified portfolio that can withstand market ups and downs. Ready to learn how to make smart investment choices and navigate the stock market with confidence? Let's get started. Let's start with the main idea behind a random walk down Wall Street, the random walk theory. So, what exactly does random walk mean? In finance, this theory suggests that stock prices move randomly and are essentially unpredictable, especially in the short term. It's a bit like flipping a coin. You can't predict if it'll land heads or tails. Similarly, you can't reliably predict whether a stock's price will go up or down tomorrow. Now, this might sound a little discouraging at first. After all, we'd all love to know which stocks will rise tomorrow or next week. But here's where Malkiel's approach is refreshing. Since stock prices are unpredictable, even experts have a hard time beating the market consistently by trying to pick the right stocks. Instead of trying to outsmart the market, you can succeed by taking a simpler approach, investing in the entire market through an index fund, rather than betting on individual stocks. Think of the stock market like the ocean. The waves go up and down, but while you can't predict the movement of each wave, if you stay in the water long enough, you'll notice that the overall tide tends to rise over time. The key takeaway here is that, because the market as a whole tends to grow over the long term, investing in it broadly through something like an index fund can be a smart and steady strategy. So, rather than stressing over each stock's daily price movements, the random walk theory suggests focusing on the bigger picture, investing broadly and staying in the market long enough to capture that long-term growth. It's a practical way to invest that doesn't require constant monitoring or guesswork. This approach can save you time, stress, and potentially give you better results over the long run. Now, let's look at a theory closely related to the random walk theory, the efficient market hypothesis, or EMH. The EMH suggests that stock prices reflect all available information at any given moment. In other words, the price of a stock already includes everything that's known publicly about that company, its earnings, future prospects, and even recent news. Think about it like this. If a company announces that it had a great quarter with record profits, the stock price might jump up quickly because investors now see it as more valuable. Similarly, if bad news comes out, like a lawsuit or a product recall, the stock price may drop just as quickly. The efficient market absorbs this information almost instantly, adjusting stock prices to reflect the new reality. The implication of the efficient market hypothesis is huge. Since all available information is already baked into stock prices, it's nearly impossible to consistently pick undervalued or overvalued stocks, unless you have insider information, which is illegal. This means that trying to outsmart the market by finding hidden gems or timing your buys and sells based on public news is very challenging, even for seasoned investors. So, what does this mean for regular investors like us? It means that rather than trying to pick the next big stock or timing your trades, it's smarter to invest in a diversified portfolio that mirrors the overall market. You're not trying to beat the market. You're simply riding along with it and benefiting from its natural growth over time. One of the best ways to do this is through an index fund, which is essentially a basket of stocks that mirrors a particular market index, like the S&P 500. With an index fund, you own a small piece of all the companies in that index, allowing you to benefit from the general upward trend of the market without worrying about picking individual winners. One of the most valuable lessons from A Random Walk Down Wall Street is the power of index funds. If you take only one thing from this book, let it be the potential benefits of investing in index funds. But first, what exactly is an index fund? An index fund is like a basket that holds all the stocks in a particular market index, such as the S&P 500. Rather than trying to pick which individual stocks will perform well, you own a small piece of all of them, which spreads out your risk and allows you to grow with the market over time. Think of it this way. Imagine you're at a horse race. Instead of betting on just one horse to win, you place a bet on every single horse in the race. While some horses may lose, others will win, and because you've spread out your bet, you're likely to come out ahead overall. Index funds work in a similar way. You're essentially betting on the entire market, so even if some companies perform poorly, the overall growth of the market means you're still likely to profit in the long run. Research has shown that over long periods, index funds often outperform actively managed funds, where experts try to pick the best stocks. Why? Because index funds have lower costs, lower taxes, and they capture the broad market's natural growth. It's the classic tortoise and hare story. Slow and steady wins the race. By keeping costs low and riding the market's natural growth, index funds provide a solid foundation for long-term investing. And here's another big advantage. Index funds are incredibly simple. You don't need to worry about picking stocks, analyzing financial statements, or trying to time the market. Instead, you can focus on contributing regularly to your index fund, knowing that you're invested in a broad, diversified mix of companies that grow over time. It's a straightforward, stress-free way to invest. Many financial experts, including Warren Buffett, advocate for index funds as the best investment option for most people. Buffett even mentioned in a letter to his shareholders that he's instructed his own estate to invest primarily in index funds after his passing. This just goes to show how effective and reliable index funds are for building wealth over the long term. So, if you're looking for a simple and effective way to invest, an index fund might be exactly what you need. It allows you to capture the growth of the market, stay diversified, and avoid the high costs and complexity of active management. It's a tool that every investor, from beginners to pros, can benefit from. One of the biggest mistakes investors make is trying to time the market. Market timing is when you try to predict when the market will go up or down and then buy or sell accordingly. But here's the hard truth. Nobody, not even the experts, can consistently predict the market's movements. Even seasoned investors have a hard time getting it right. Malkiel emphasizes that even missing just a few of the market's best days can seriously hurt your long-term returns. Imagine you sell your stocks because you think the market will drop, but then it goes up unexpectedly. You've missed out on that growth, and even if you jump back in, you're likely to have missed a significant gain. The better strategy is to stay invested for the long haul and ride out the ups and downs. Remember, it's not about timing the market, it's about time in the market. Staying invested through the highs and lows is how you capture the long-term growth of the market. Market timing can be tempting, especially when the news is full of predictions, but in reality, nobody can consistently time the market, so don't try to outsmart it. Let your investments grow steadily over time. Diversification is another key principle from A Random Walk Down Wall Street, and it's essential for managing risk in your investment portfolio. Diversification means spreading your investments across different asset types like stocks, bonds, and real estate, so that you're not putting all your eggs in one basket. This reduces your overall risk because when one investment type goes down, another might go up, helping to balance your portfolio. Imagine you're at a buffet with lots of different dishes. If you only eat one dish and it turns out you don't like it, you'll leave unsatisfied. But if you try a bit of everything, you're more likely to enjoy your meal. Diversifying your investments works the same way. It increases your chances of success by spreading out your risk across a variety of assets. Diversification doesn't just protect you from big losses, it also positions you to capture growth in different areas. For example, if the stock market dips but the real estate market is booming, your diversified portfolio will be able to withstand the ups and downs. The key is to build a balanced portfolio that grows steadily over time. Think of it like building a well-rounded meal that gives you all the nutrients you need. And here's something to remember. Diversification isn't just about investing in a bunch of different stocks. True diversification includes different asset classes, such as bonds, real estate, and even international stocks. By having a mix of assets, you're better prepared to weather different economic environments. For example, during a recession, bonds may perform better than stocks, helping to cushion your portfolio from losses. So, if you're building an investment portfolio, make sure you're diversified. It's a powerful way to manage risk, increase your chances of steady growth, and keep your portfolio resilient through various market conditions. So, what can we learn from a random walk down Wall Street? First, remember that the stock market is unpredictable in the short term. So rather than trying to pick individual winners, it's usually smarter to invest in the whole market. Second, index funds are a powerful tool that allows you to capture long-term market growth without the hassle of picking stocks. Third, resist the urge to time the market. Instead, stay invested and let time work in your favor. And finally, diversify your portfolio to spread your risk and increase your chances of success. By following these principles, you can take control of your financial future and build wealth over time. Remember, investing doesn't have to be complicated. By focusing on low-cost, diversified investments like index funds and following a steady, long-term approach, you can make smart, effective choices that will pay off in the long run. If you found this video helpful, please give it a thumbs up, share it with your friends, and subscribe to our channel for more easy-to-understand financial advice. Thanks for watching, and see you next time.